So Brexit is such an important topic and theme, both UK politically and economically, but it seems that for most of this year, Brexit was drowned out by the noise and the headlines from COVID. Here at NatWest Markets, we are Brexit ready, oven ready, and our Dutch entity is set up. We've got staff, capital, and more importantly, a way of servicing our European customers. So let's kick off, starting more sort of top down or more macro view from Ross. And maybe, Ross, my first question is, the markets have, I guess, reacted positively to trade deal developments. Do you share this view?
Yes, I think our views look in line with market pricing, namely that the probability being attached to some form of deal, probably a fairly thin deal, is fairly high, 75, 80% probability, something like that. Though not 95. I mean, the process is still quite opaque. There are still some remaining stumbling blocks. So we're not quite there yet, but presumably within the next week or so, we would expect to see some significant development, quite possibly an agreed trade treaty text emerging.
Okay, and what should we expect, do you think, in focusing on access to the economic markets and the Brexit trade deal? How much more is there further to play out?
Well, at the moment, it looks like the main stumbling block is agreeing fishing access, which is in some ways quite technical, but it feels like something which really accounts for 0.2% of GDP is unlikely to hold up an eventual deal. So we get the deal done. Nevertheless, we think there will be some problems, some frictions in the the early part of next year. The Bank of England has estimated that some of these frictions, so problems, blockages around border checks, additional bureaucracy, disruption to the supply chains, new IT systems, and so on, could knock a full percentage point off UK GDP. So, as you said in the introduction, were it not for the pandemic, this would be a much bigger issue, I think, for markets. And the pandemic, therefore, should not completely obscure the potential near-term difficulties around the Brexit deal.
The expected deal is largely goods focused. Do you expect the UK and Europe to embark on further trade negotiations and other sectors such as finance?
It's possible, but I think it's unlikely. We've had several years where the UK and the EU have been working to hammer out some form of post-Brexit settlement. And I think there's a sense of exhaustion on both sides. So I think it will probably be a few years before the UK and EU re-engage in any comprehensive way, perhaps trying to find some treaty in services, for example. And I think politically there's probably a motivation for the UK to try and find deals with third countries, most obviously the US, but also those faster growing Asian economies.
Yeah, and talk to me about the US. So we've now got Biden and not Trump. How does that play out from a UK standpoint?
Well, most immediately, I think the positive is that because the incoming US administration is far less sympathetic to Brexit, and certainly the White House will have greater concerns potentially around Northern Ireland and the Irish border, I think there is more immediate pressure on the UK government to get a deal with the EU. So I think this is one of the positive factors in the near term. However, an incoming administration will have to make new executive appointments, a new trade secretary, and so on. So I think the process may be a little bit slower than if you'd had Donald Trump being re-elected. And I think as well, of course, the fundamental problem for the UK is that the US has far less need for a trade deal. There's much less urgency on the US side.
Thanks, Ross. So maybe we just sort of lift and look under the bonnet a bit more and bring Paul in. So from a currency markets perspective. So I guess, Paul, to what extent do you think recent sterling strength reflects the financial markets pricing in a Brexit deal with increased confidence?
Well, I think it's clearly part of the story. A no-deal Brexit has always been seen as the most negative type of Brexit in terms of currency outcome. And financial markets have a couple of outcomes here. It's deal versus no deal. They can assign probabilities and expected changes in the exchange rates. Bring all that together. That gives you a valuation for sterling. As those probabilities move, so will sterling. And it looks like, judging by our conversations with clients, that markets have priced in a deal with more confidence, and that's translated into sterling strength. That seems right from a currency perspective. You think there's been more talk of concessions on both sides. You've had a second COVID-19 wave, which I think has just focused the minds on the importance of getting a deal. And also, there's so little sort of no deal advertising from the government just 5 weeks, 6 weeks until the end of the transition deal. It feels like markets would have priced that with more confidence. Now, it's not the only thing, the only game in town. You've had recent news of a vaccine. The UK economy has been hit very hard because of COVID-19, and it should benefit from a vaccine. I think that's reflected a little bit. And also, when you look at sterling dollar, it's important to remember that it's the dollar that's been under pressure. So cable has been a lot higher than perhaps you would have thought just simply on Brexit. But it's definitely part of the story. And it means that if there is a sudden dip to a no-deal Brexit, then sterling can move a very long way.
And Paul, noting all the things that Ross talks about that are still to play out, how confident are you that these levels can be maintained?
I'm much more confident about the short term and holding these levels. Over the medium term, over 1 year, then I would be much less confident. Over the short term, I think it's important to understand that international investors are probably underweight UK assets. Maybe there's some short speculative positions. There's probably some long-term hedges to protect UK assets from any kind of adverse impact from Brexit. And of course, you've got a couple of catalysts that could squeeze that. So if we do get a deal, that no deal risk of 10-20% goes to zero. That supports the currency. If we get a vaccine, for example, coming a little bit earlier, I think that's going to play positive as well. And also the infection numbers in the UK are heading lower as well. So short term, I think quite positive. Over the medium term, it's just less positive. You start thinking about Brexit's impact on the supply side of the economy, free movement of labour, productivity, a bit more inflationary, maybe a larger current account deficit in the future. And crucially, the level at which that can be sustained by foreign direct investment and portfolio flows. And if growth is expected to be weak, it's going to be harder. So the sustainable current account moves. And the other one is just the economic scarring from COVID-19. I know this call is about Brexit, but as Ross has outlined in his various pieces, a very poor performance in Q3 just placed the idea that the scars are going to run quite deep, and that keeps growth low in a year where we think growth expectations, relative growth, are going to be really quite important. So that medium-term outlook, not so positive. Short-term, maybe potential for sterling gains against the safe haven currencies.
Thanks, Paul. Quite sobering thoughts there. Maybe we move over to Theo now, and then and look at the rates market. So, Theo, so what do you think about the impact of Brexit deal and the impact on the inflation market?
Yeah, I think, first of all, the inflation market has been a clear indicator of market sentiment with regards to Brexit and the type of the deal. To the extent that we have a deal and that deal seems to work, obviously this will push real yields higher. We expect a flattening of the real rate term structure. We do expect also inflation swaps at the front end of the curve to cheapen, so the market trades at a premium. So this will be very significant for the front end of the curve. I think that this is still an underpriced risk. So Brexit and real yields, this will be big, and it means that we should expect real rates at the front end to move something between 15 to 20 basis points higher on the delivery of a deal.
Thanks to all the speakers. I think naturally the focus is very much around the future of the UK economy, but actually looking a little bit close to home, we need to maybe consider the financial market sector and how that's going to operate in a post-Brexit environment. There's been a top-down consultation covering the UK regulatory framework ahead of recommendation and changes to individual regulations. How does the UK want to regulate the financial services sector, and how will this differ from today? I guess is something that many people are looking at beyond sort of just the UK economy. It is clear that the UK will diverge from EU financial markets regulation, especially the prudential regulation like Basel III, and the UK Treasury's consultation on the future financial framework should provide some input into what we expect to go forward. And we've seen examples already where there's been divergence.